Hello everyone, this video will give you a great checklist if you just incorporated your business, and I will be telling you the first things that you need to do with your new business. I will also be telling you the two different strategies of taking money out of your corporation. Now, since that you've made the big decision to incorporate your business, now you want to set up your corporation the right way because you don't want to have any issues down the road where it will cost you 2-3 times more than what it costs you to start up your business. I've had the pleasure to deal with some of clients in the past where I help them set up from A to Z their new corporation, so I believe that this video will be very informative for you. For those of you who don't know me, my name is Ryan Banks and my channel is about financial tips and tricks that you can bank on, and I post videos every second Monday at 5 p.m. Eastern. Once you receive those incorporation papers from your lawyer, the first thing that you should do is open up a corporate bank account. So go book an appointment with your advisor. The only thing that you need to open up a corporate bank account is the articles of incorporation. Now, once you've opened up your account, the first transaction should be the amount that you paid for the shares of the corporation. This varies corporation to corporation. It all depends on how you set up your own corporation. But in the past, I've seen $1 or even $100, or sometimes it's also different. But definitely go talk to your lawyer to see how much you need to pay for those shares. And if you do this, this will avoid future complications with CRA if you ever get audited. Now, once you've deposited the amount for the shares, now you could deposit another amount for the amount to sustain the first startup costs of your corporation, and then you can also transfer those automatic payments if you have any from your sole proprietorship, or start putting all those expenses through the corporation, because it will be a lot easier for you to do your bookkeeping if all the transactions are in one bank account. The second main thing that you should do when you first start up your corporation is set up a business CRA account. This will allow you to see and have all the information for your corporation in one place from the government, and you'll be able to also submit various reports. If you don't know how to open up your own CRA account, you can go watch my previous video as to how I go step by step and show you exactly how to set up your own CRA account. In that video, I did do it personally, so I will put the link in the description as to which section that you should pick to be able to register for that account. And the only other thing that you will need is a CRA business number, where you should receive that in the mail as soon as you incorporate your business. Once you have full access to your CRA account, the next thing you want to do, and this is definitely applies to you case by case, but is to open up an HST account if you have over $30,000 of revenue in a year, and a payroll account if you have employees or if you plan to pay yourself through salary base. Now, for filing your HST and payroll reports, what you need to think about is, for HST, if you have over $30,000 of expected revenue, you need to open up an account. And for filing purposes, usually it's quarterly, but if you have a lot of revenue, it can become monthly. Now, for payroll, this is also monthly, where you need to deduct and pay the government for CPP, EI, and also taxes withheld for each employee. Now, for your annual obligations, which is your corporate tax return or your T2, where you will need to set that up and file every year. So when you start a new corporation, you don't have a defined year end yet, and you only get a defined year end as soon as you file for the first time. And this doesn't have to be December 31st. This can be any last day of the month, and that's when you choose. So when you file your first corporate tax return, and the year end date that you have, that's going to be the same year end date you have year after year. Now, one thing to remember is, at the day that you incorporate your business, or the date on your articles of incorporation, you have exactly 53 weeks to file your first corporate tax return. And for filing purposes, if you owe taxes or you plan to pay taxes, you have 3 months after your year-end date to file your corporate tax return. But if you plan to have a refund, then you have 6 months to file your corporate tax return. But you definitely want to have that conversation with your accountant to see when it's the best time to file. Now, for the second part of the video, I will be explaining the different ways that you can take out money out of your corporation. And the two different ways is a dividend structure and also a salary-based structure. Now, the first structure I'm going to talk to you about today is a dividend structure, which is one of the most common ways that people structure to take out money out of the corporation. So there are different ways that you can do this. Number one, you can pay business expenses personally, where the corporation will owe you money. That money will be paid to you tax-free. But on the other hand is if the corporation pays personal expenses for you, or if you take out money, let's say $1,000 every month, that means that you will owe the corporation money. When that happens, and when it comes to year end, the corporation will issue you a dividend or a T5 under your name personally, where you will get taxed. So those, I guess, are two different structures or two different ways that you can take out money through a dividend structure. Now, one good tax strategy that a lot of accountants might suggest to you is issue you a dividend even though you don't have any income personally. One of the main reasons is you're going to be able to apply those non-refundable tax credits from your personal tax return onto the income of your dividend that you receive from the corporation. This doesn't mean that you need to take out the money out of the corporation, because let's say you issue a dividend, that means the corporation owes you money, and when that's the case, you can build up that loan to yourself, where later down the road is if you want to take out more money, if you want to buy a house, or if you have any other projects that you want to do, you won't need to have or to pay a lot personally at a higher tax bracket, because you're already going to have that big amount of the shareholder loan or the amount that the corporation owes you, where you can take that out tax-free. Now, there are two little disadvantages of having a dividend structure. So number one is you're going to have to file a T5 where you're accounting to do this, but this will also add on like an extra $100 or $200 onto your year-end bill. The other thing is, if you have a dividend structure, that means you don't get an RSP contribution room because you're not salary based, because RSP is based solely on a percentage off of your salary that you make, which is usually you get through a T4. The second structure I want to talk to you about today is a salary-based structure to take out money out of your corporation. So this is structured like saying that you got hired from your corporation so that you can run your business. So this can vary on the amount that you get based off of how specialized your work is, and also you can work in different tax strategies with your accountant to say how much you should pay yourself based off of the different tax brackets in your province. Now, the biggest advantage of having a salary-based remuneration is that you can contribute to RSPs, because that calculation is strictly based off of your salary. Another thing that you can do is talk to your accountant on different ways that you can structure your salary or the way that you get paid. You can definitely put a smaller amount for your salary throughout the year, and then at the end of the year you can give yourself a bonus. But this is definitely something that you should talk to your accountant about. Now, some of the biggest disadvantages of being salary-based is that you need to pay source deductions and remit those monthly. So this means you need to pay for CPP for sure, EI is optional, and also taxes withheld. So the corporation pays a portion of that as well, and you also pay personally. So that's an additional cost that you need to think about. To summarize the video, once you have those articles of incorporation in your hands, the two things that you want to do is to open up a corporate bank account and also your business CRA account. The other thing I want to keep in mind is meeting all those reporting deadlines, which means your corporate tax return every year, your T5 if you go to dividend structure, you have your HST remittances if you have over $30,000 of revenue, and also your payroll remittances if you have employees or if you pay yourself a salary. If you have any questions, you could definitely email me at ryanbankscpa@gmail.com, or you can write a comment below. So I just want to thank you for watching the video, and I hope you have a great day.